A trader in New York stares at a Treasury screen. A pension manager in Tokyo watches a government bond auction go sideways. An American family refreshes a mortgage quote and wonders why the monthly payment just jumped again. Those three moments look unrelated. They are the same story. Japan's bond market is starting to move like a market again, and that single change threatens to reprice debt all over the world. News headlines frame this as a Japan problem. Wealth Reality says it is a funding problem for the entire global system, because for decades, some of the cheapest money on earth came out of Japan and flowed straight into American assets. Picture the setup that made this possible. Japan built a financial world where debt looked enormous on paper and strangely harmless in practice. The government borrowed, the central bank crushed interest rates toward zero. Bond yields stayed, pinned down so tightly that the cost of carrying a mountain of debt barely felt real. Market noise said Japan was a miracle of stability, a country that had somehow escaped the rules that punish over-borrowing. Wealth Reality was harsher. The danger was never removed. It was anesthetized. The bill did not disappear. It sat quietly on the table, which that illusion began after one of the most violent asset booms in modern history. Japan's late 1980s bubble turned land, stocks, and prestige into a national fever. Prices rose until reality looked old-fashioned. Then the fever broke. Equity wealth vaporized. Real estate cracked. Confidence did not merely fall, it withdrew into a shell. Consumers learned to wait. Businesses learned to hoard caution. An entire economy drifted into deflation, where spending tomorrow felt smarter than spending today. Market noise called lower prices healthy and consumer-friendly. Wealth Reality exposed something uglier. When everyone delays action, cash flow dries up, companies freeze, hiring weakens, and the economy starts feeding on its own hesitation. The Bank of Japan answered that paralysis with extraordinary force. Rates were pressed to zero, money was created at scale. Yield curve control turned the bond market into a managed stage play, where the central bank stood ready to buy whatever it needed to keep yields from rising too far. Imagine a trading floor where one participant becomes so dominant that price discovery turns into policy enforcement. That was the model. Bonds no longer reflected clean market judgment about risk, inflation, or fiscal discipline. They reflected the determination of the central bank to prevent gravity from reappearing. For years that looked brilliant. Borrowing stayed cheap. Debt stayed serviceable. The machine kept running. Now the machine is grinding. Inflation showed up in a country that had spent decades acting as if inflation belonged to some other era, some other nation. In the United States, a 3% inflation print might look tame next to recent shocks. In Japan, it feels like the walls moving. Consumers raised in a low-price culture suddenly face rising costs. Investors who spent years treating zero yields as natural now have to price a world where money carries a cost again. This is not a small policy adjustment. It is a regime change. The kind that forces portfolios, institutions, and governments to rethink habits built over 30 years. The first visible crack appears in Japanese government bonds. When the biggest buyer in a market starts stepping back, the silence disappears. Prices soften, yields climb. Long-dated bonds move in ways that feel ordinary in other countries and seismic in Japan. A yield that once looked impossible now sits on the screen like a warning flare. Political promises make it worse. The second, a government hints at more. Spending and lighter taxation without a clean funding path, bond traders start marking up the cost. No ceremony, no waiting period, no patience. Market noise says fiscal promises are popular and stimulative. Wealth Reality says bond investors care about one thing first: who is going to absorb the extra debt and at what yield? That is where the story crosses the Pacific. For years, Japanese institutions lived off a deceptively simple trade. Borrow in yen at almost nothing. Convert that money into dollars. Buy higher-yielding US Treasuries or other American assets. Collect the spread. Do it at scale. Do it with discipline. Do it until it feels normal. The trade worked because Japan offered ultra-cheap funding and the US offered meaningfully higher returns. That gap helped support Treasury demand, stock valuations, and broader liquidity conditions in America. Market noise celebrated US asset strength as proof of domestic resilience. Wealth reality admitted a less flattering truth. A meaningful portion of that strength was financed by foreign capital exploiting a rate imbalance. Visualize the trade like a conveyor belt. Cheap yen enters one side. Dollars, treasury bonds, equities, and risk assets stack up on the other. As long as exchange rates behave and the yield spread stays attractive, the machine prints elegant profits. A fund manager sees a near zero funding cost on one side and 4 or 5% on the other, and the math feels almost insulting in its simplicity. Greed loves trades that look mechanical. Institutions especially love them when the strategy can be repeated without needing heroic forecasting. That steady flow of Japanese capital became one of the quiet background forces keeping America's borrowing costs lower than they otherwise would have been. Now, shrink the spread. Raise Japanese yields. Add hedging costs. Add currency volatility. Add the simple fact that domestic bonds suddenly offer a return that no longer feels embarrassing. The trade loses its charm fast. A Japanese insurer or pension fund does not need a lecture in patriotism to bring money home. It needs math. Once home market yields start looking respectable, overseas complexity becomes harder to justify. Currency risk feels heavier. Treasury demand feels optional. The question shifts from why not buy America to why leave Japan at all. That question alone can reprice a great deal of global capital. This is where people miss the danger. They imagine a slow portfolio rotation and a few dry headlines about international flows. Then they forget that leveraged systems do not always unwind politely. When carry trades reverse, positions are sold for reasons that have nothing to do with the quality of the underlying asset. Traders dump what they can, not just what they dislike. Risk assets wobble. Bond markets lose sponsorship. Safe havens stop behaving like safe havens. A screen filled with red does not tell you which position was wrong first. It tells you funding conditions changed. Market noise blames isolated catalysts. Wealth reality points to the plumbing. When the cheap source of money tightens, everything built on top of that source feels it. America is especially exposed because it needs constant buyers for a staggering amount of debt. Deficits have to be financed. Existing debt has to be rolled over. New issuance keeps arriving like fresh cargo at a port that cannot afford fewer ships. If one of the largest foreign support pillars buys less or sells more, yields move higher to attract replacement demand. That change does not stay in the Treasury market. It runs through mortgages, auto loans, corporate credit lines, commercial, real estate, and equity valuations. A home buyer sees the result first as a number on a monthly payment. A business owner feels it in financing costs. An investor sees it in a lower multiple on future earnings. Higher sovereign yields are not an abstraction. They are a tax on optimism. Imagine a family shopping for a $400,000 home. The house looks the same. The neighborhood looks the same. Their income may even look a little better than it did last year. Then rates climb and the mortgage payment jumps by hundreds of dollars a month. That is the cruelty of the bond market. It changes affordability without changing the house. It changes corporate behavior without changing the factory. It changes stock valuations without changing the product. One movement in the discount rate can drain demand from an entire economy. Market noise says the consumer is resilient. Wealth reality says resilience weakens fast when the cost of money keeps rising. The portfolio consequences are just as uncomfortable. Investors were trained to believe that bonds cushion stock declines. Often they do. That relationship becomes far less reliable when the main pressure comes from rates, sovereign supply, and doubts about fiscal durability. In that environment, both sides of a classic 60-40 portfolio can sink together. The dashboard that once looked balanced starts moving in one ugly direction. Stocks fall because future earnings are discounted more harshly. bonds fall because yields are rising and supply is heavy, the old refugee stops acting like a refuge. That is not a temporary mood swing. It is what happens when the cost of capital, not just growth expectations, becomes the market's obsession. Japan's demographic profile makes the background even darker. Picture a country with fewer workers each year, more retirees drawing on the system, more healthcare costs, more pension obligations, and less natural tax capacity to absorb the burden. A shrinking population does not simply reduce consumer demand. It weakens the long-term machinery that supports sovereign debt. Fewer births today become fewer taxpayers tomorrow. More elderly citizens mean larger claims on public resources. Debt math becomes more fragile even before a crisis appears on the surface. A country can tolerate huge leverage longer when it is growing, producing, and replenishing its workforce. That escape route narrows when the population ages and contracts. At the same time, several paths can follow from here. The softest path is a managed grind. Japan normalizes slowly. Investors adapt over time. US yields rise in steps instead of spikes. Asset prices absorb the change with bruises rather than fractures. A harsher path begins with an external shock. Energy prices, geopolitical stress, a fresh inflation scare, or a political mistake that causes investors to question fiscal control more aggressively. Then the unwind accelerates. The ugliest path is a true loss of confidence in Japan's debt structure itself, where the market begins to doubt not just policy precision, but the sustainability of the whole arrangement. Most analysts still treat that outcome as a tail risk, not the base case. Tail risks matter when the underlying debt pile is historically extreme. The real point is simpler than the headlines make it sound. The age of Japan quietly subsidizing. The world with near-free money is ending. The age of America enjoying endless foreign demand for its debt at comfortable yields is ending with it. This is not a cinematic collapse that arrives with one dramatic bell ringing at the opening of the market. It is more dangerous than that. It is structural. It can bleed into the system month by month, auction by auction, mortgage, quote by mortgage, quote, until households and investors finally realize the old world is gone. Smart positioning in a world like this starts with respect for quality. Strong balance sheets matter more when debt is expensive. Excess leverage becomes a slow poison when refinancing costs keep drifting upward. Hard assets become more interesting when confidence in paper promises starts weakening. Watching the 10-year Treasury yield becomes less of a macro hobby and more of a practical necessity, because that number leaks into almost every major financial decision downstream. The investor who understands rate pressure early does not need perfect foresight. The investor only needs to stop pretending that yesterday's easy money assumptions still apply. The market's noise will keep selling comforting stories. A temporary scare, a foreign issue, a contained adjustment, a technical bond market event that ordinary people can safely ignore. Wealth reality says the opposite. Japan sits near the center of a financing web that has influenced American rates, valuations, and liquidity for years. When that center shifts, the effects do not remain in Tokyo. They land in US Treasury auctions, housing affordability, portfolio correlations, and the cost of staying financially afloat. The screen in Tokyo flickers. A mortgage quote in America changes. The connection is no longer hidden.